Something strange is happening right now. The stock market is soaring to record highs, but the US dollar, the world's reserve currency, is quietly losing strength. Wait, what? Shouldn't a strong economy and a booming stock market strengthen the dollar? It sounds like a paradox, and it is one. But once you understand how money actually moves, you'll see this isn't chaos, it's the system working exactly as designed. So in this video, we'll break down why the dollar is falling, why stocks are soaring, and what this paradox means for investors like you. Let's start with the basics. When you hear the dollar is falling, it doesn't mean the paper in your wallet is shrinking. It means the US dollar's value compared to other currencies is going down. Now that's measured by something called the US dollar index, or DXY, which compares the dollar to a basket of currencies like the euro, yen, and pound. As of early October 2025, the dollar index sits around 97.7, down roughly 0.7% this month. About 4% over the past year and more than 10% year to date. This is one of its worst stretches since 1973. At the same time, the S&P 500 has climbed over 12% this year, hitting record levels near 670 points, with the biggest gains coming from global tech and industrial giants. So, how can stocks and dollar move in the opposite directions? Think of it like this. When the economy and markets are in a transition phase, the reasons for optimism in one part of the system are the same reasons for weakness in another. In plain English, what's good for the stock market can actually hurt the dollar. This paradox starts with one thing: expectations. Not just what's happening right now, but what investors believe will happen next. Let's start with the easy part: why stocks are flying high. First, investors are betting that the Federal Reserve will soon cut interest rates. Lower rates mean cheaper borrowing, more corporate investment, and higher profits down the line. It also means future cash flows, the money companies will earn, looks more valuable today. That's why stock valuations rise even if the economy itself feels lukewarm. Second, big multinational companies, think Apple, Microsoft, Coca-Cola, they make a ton of money overseas. When the dollar weakens, the foreign revenue they bring home converts into more US dollars. That inflates their profits, pushes their share prices up, and lifts the entire market index. And finally, there's psychology. After years of uncertainty, investors are in a cautiously risk-on mode. They're moving money out of cash and short-term bonds into assets they believe will hold value if rates fall, like stocks, gold, and even real estate. It's a strange mix of confidence and caution. People are chasing returns, but they're also hedging against what could go wrong. And when that much money moves at once, prices in almost everything from tech stocks to gold start rising together. Now here's the other side of the paradox. Those same forces, optimism, rate cuts, risk-taking, are exactly why the dollar is sliding. When markets expect rate cuts, the yield on US bonds fall. That makes the dollar less attractive for global investors who want income from holding it. In simple terms, the dollar becomes a less rewarding place to park money. Meanwhile, other countries may be holding rates steady or seeing stronger growth. For example, in 2025, currencies like the euro and Swedish krona have climbed sharply against the dollar. So as the US softens, the rest of the world looks relatively stronger and capital starts flowing out of the dollar and into other markets. And there's also confidence in perception. In 2025 alone, we've seen rising US government debt, which is now over $35 trillion, political standoffs around government spending, and government shutdown. When headlines like that hit, global investors get cautious. Even though the US economy is strong on paper, trust wavers, and that quietly chips away at the dollar's strength. This is where the paradox completes its circle. When the dollar weakens, US exports become cheaper abroad. That helps US companies sell more, boosting profits and pushing stocks even higher. So the weaker dollar actually feeds the stock market rally. But that rally, based on expectations of lower rates and easy money, keeps the dollar weak. It's a feedback loop, a cycle of optimism. Economists even have a name for this pattern: the dollar smile. When the US economy is booming or in crisis, the dollar strengthens. But in the middle phase, moderate growth, mild inflation, steady optimism, the dollar often weakens. And that's exactly where we are right now. Of course, nothing lasts forever. There are a few ways this story could flip overnight. If inflation suddenly picks up again, the Fed might pause or even reverse those expected rate cuts. That would instantly make the dollar-bound assets more attractive, strengthening the dollar and cooling the stock rally. Or, if a major geopolitical event or financial crisis hits, investors could rush back into the dollar as a safe haven, sending it soaring while stocks fall. Even fiscal concerns like ballooning debt or gridlock in Congress can shake confidence in both markets, creating volatility in both directions. So, what does this all mean for you, the everyday investor who's watching their portfolio while wondering what the dollar slide really means? Well, if you hold US stocks, a weaker dollar actually helps you if you own global companies. Their overseas earnings rise in dollar terms. But if you plan to travel abroad, import goods, or invest in foreign markets, a weak dollar can make things pricier. For international investors who hold American assets, a falling dollar eats into returns once converted back to their own currency. That's why some funds hedge their currency exposure to protect against these swings. The key takeaway here is don't panic about the paradox. Understand it. The falling dollar doesn't always mean trouble, sometimes it's the fuel for a rally. So yes, it's a paradox. The stock market is soaring and the dollar is falling, and both are right. Because when investors expect easier money, risk assets rise and the dollar, no longer the only safe bet in town, takes a breather. It's a reminder that markets aren't moral, they are mechanical. And when you understand the mechanics, paradoxes suddenly make perfect sense. If you learned something new today, give this video a thumbs up. Share it with someone who's confused about the markets and let me know what you think. Do you think the dollar will keep falling or is a rebound coming? Thanks for watching, and I'll see you in the next one.